Chapter 2, Professional Standards. Standards are established to guide performance and to provide criteria to measure the performance of individuals and organizations. In public accounting, there are three standard-setting bodies for auditing standards. These are the AICPA, which sets audit standards for audits of non-public companies in the United States, the PCAOB, which sets standards for audits of public companies in the U.S., and the last is the International Auditing and Assurance Standards Board, which sets standards used in various countries with differing levels of authority. The international auditing standards are called IAS. Authority to set standards is determined by law in some cases and by adherence in others. For example, the Public Company Accounting and Oversight Board has the authority by law to set standards for public companies based on federal legislation. These standards apply to auditing, quality control, independence, and ethical behavior. The AICPA derives its authority to set standards for non-public companies based on their general acceptance by state boards of accountancy, other legislative organizations, and the courts. The standards apply to many of the same areas as the PCAOB does for public companies and some others in addition to those. Last, the state boards of accountancy also have authority by law to license CPAs and CPA firms to practice public accountancy, and many of these state boards adopt AICPA and PCAOB standards, but also supplement them with their own requirements. This slide shows the relationship of the three regulatory authorities for public accounting. The PCAOB is the regulatory authority for firms that audit public companies registered with the SEC and requires an integrated audit for most companies. The AICPA is the regulatory body for non-issuers, sometimes called private companies. The state boards of accountancy license individual CPAs and CPA firms that practice public accountancy in their jurisdictions. The state boards adopt AICPA and PCAOB standards because they regulate both private and public company auditors, but they can supplement these with their own standards. The AICPA's Auditing Standards Board issues auditing standards in the form of statements on auditing standards called SASs. Until 2012, the SASs were organized around the 10 generally accepted auditing standards that included general standards, field work standards, and reporting standards. These were codified and called statements of auditing standards, or generally accepted auditing standards, or GAAS. Now the 10 standards have been eliminated from the AICPA standards, but not from the PCAOB standards, therefore they are still relevant. The Auditing Standards Board replaced the 10 standards with a separate set of principles, which include the purpose of an audit, the premise of an audit, the personal responsibilities of the auditor, auditor actions in performing the audit, and reporting the results of an audit. We will look at each of these principles. The purpose of an audit is to provide an opinion on whether the financial statements are presented in accordance with the applicable financial reporting framework. In the U.S., the framework is ordinarily GAAP, or Generally Accepted Accounting Principles, but it can be whatever the suitable criteria are for a particular test engagement. The basic premise of an audit is that management and those charged with governance have the responsibility to prepare the financial statements in accordance with the applicable financial reporting framework, and that they provide the auditor with all information, such as records, documentation, and other matters that are relevant to the preparation and presentation of the financial statement. Any additional information needed, and unrestricted access to those within the entity that the auditor wishes to obtain evidence from. It is important to note that auditors have a personal responsibility to have appropriate competence, comply with ethical requirements, and maintain professional skepticism and professional judgment when conducting an audit. Professional skepticism includes having a questioning mind, being alert to conditions that may indicate possible misstatement due to error or fraud, and a critical assessment of audit evidence. In particular, the auditor must be alert for audit evidence that contradicts other audit evidence, information that raises a question about the reliability of documents and responses to inquiries, any conditions that indicate possible fraud, and circumstances suggesting the need for additional audit procedures beyond those ordinarily required. Auditors are responsible for obtaining reasonable but not absolute assurance that the financial statements follow the applicable financial reporting framework. This is very important to understand. Reasonable assurance implies that there is a low level of risk remaining that the auditors will express an opinion that the financial statements are properly stated, when in fact they are not. It is not possible to obtain absolute assurance because the nature of financial reporting and audit procedures and the need to conduct the audit within a reasonable period of time in order to achieve a balance between benefits and cost. The auditor is to report the results of the audit by expressing an opinion in written form in accordance with the auditor's findings, or a statement that an opinion cannot be expressed. The opinion states whether the financial statements are presented fairly in all material respects in accordance with the applicable financial reporting framework. Critical to the profession is the need for independence when performing audits, as well as other assurance services. An opinion by CPAs as to the fairness of a company's financial statements or other information is of questionable value unless the CPAs are truly independent. Generally accepted auditing standards have a hierarchy that auditors should follow in determining authoritative guidance. The highest level of authority is given to the standards, which basically must be applied while considering the terms discussed that indicate the different responsibility levels of unconditional versus presumptively mandatory. These include statements on auditing standards and other standards that apply for the PCAOB and governmental audits. Next are interpretive publications that are recommendations on the application of SASs and include auditing interpretations of GAAP. Last are other auditing publications that have no authoritative status but may help the auditor understand and apply the standards. These include various AICPA publications, professional journal articles, and even this textbook. Auditing standards define errors as unintentional misstatements or omissions of amounts or disclosures in the financial statements. Fraud relates to intentional acts that cause a misstatement of the financial statements. Misstatements due to fraud may occur due to either 1. Fraudulent financial reporting, or 2. Misappropriation of assets. The auditing standards require that during the planning of an audit, auditors are required to assess the risk of material misstatements, whether caused by error or fraud. This assessment includes gathering information about the company and its environment, discussion among the audit team members, and inquiries of management and others. The risk assessment process should include analytical procedures that include revenue. The process should assess the risk of errors and fraud that may cause the financial statements to contain a material misstatement. After the auditors have assessed the risk of material misstatement due to errors or fraud in the planning process, they should plan and perform the audit in such a manner that they obtain reasonable assurance that material misstatements will be detected. Exercising due care in planning, performing, and evaluating the results of audit procedures requires that the auditor use professional skepticism, which we have previously discussed. Auditors are also required to identify client noncompliance with laws and regulations, depending on their nature. There are 2 types of laws: laws that have direct effect on the financial statements and amounts, and those that do not. Noncompliance with laws that have a direct effect result in the need for accounting journal entries, and auditors should gather sufficient appropriate audit evidence to obtain reasonable assurance of detecting material misstatements resulting from these types of noncompliance. Other laws dealing with operating aspects of the business do not require that auditors design procedures to provide reasonable assurance of detecting noncompliance, but auditors should be alert for these if found and make inquiries of management about compliance. Additional audit procedures are required for all illegal acts when non-compliance is identified or suspected. In such situations, auditors should 1. Obtain an understanding of the act and the circumstances in which it has occurred, and 2. Obtain further information to evaluate the possible effects on the financial statements. This slide shows the current information that is included in the auditor's standard or unmodified report for public clients per the PCAOB regulations. This report is issued when the auditors are taking no exceptions and inserting no modifications or qualifications in the report. The audit report for public companies was recently changed by the PCAOB. Some of the information is the same as the previous audit report, but in a different order. For example, the opinion paragraph, which was normally last, is now the first paragraph of the report. The basis for opinion matter paragraph now follows after the opinion paragraph, and a new paragraph has been added called Critical Audit Matters. The heading of the PCAOB report is Report of Independent Registered Public Accounting Firm and is addressed to the shareholders and board of directors of the company. The opinion paragraph section of the auditor's report begins by stating that an audit of the specified financial statements was performed and then provides the auditor's opinion. When the auditors have also performed an audit of the client's internal control over financial reporting, the opinion section also includes that information. In such a situation, the auditors may either issue separate reports on the financial statements and internal control, or they may issue a combined report. The basis for opinion paragraph describes the responsibilities of both management and the auditors, and the nature of an audit performed in accordance with PCAOB standards. It also alludes to the requirements of registration and independence in accordance with SEC regulations and PCAOB rules. The paragraph concludes with the statement that the auditors believe that these audits provide a reasonable basis for their opinion. Effective in 2019 for large public companies and 2020 for other public companies, the PCAOB requires the auditors to present in their reports critical audit matters. Critical audit matters are those that relate to financial statement accounts or disclosures and involved especially challenging, subjective, or complex auditor judgment. Last, the audit report ends with the date that the auditors obtained a sufficient appropriate evidence to support their opinion. The report is signed in the name of the firm with the city and state of the firm that issued the report. Also, the PCAOB has added a requirement of a statement of when the firm began serving as the corporation's auditor. The Auditing Standards Board of the AICPA is currently in the process of making similar changes to the report of non-public companies, but for now the report has not been changed as the PCAOB report. The standard audit report consists of a title, addressee, content sections that include an introductory paragraph, paragraphs addressing both management's and the auditor's responsibility, and last, an opinion paragraph. There is a signature area, usually with the firm's name and the city and state of the office issuing the report and a date. Audit reports are titled as Independent Auditor's Report for a non-public company and are addressed to the person or persons who retain the auditors. In the introductory paragraph, the auditing standards require that the financial statements and associated notes that have been audited be identified and the dates of those statements. The management responsibility paragraph contains the information that management has taken the responsibility for preparing and presenting the financial statements in conformity with GAAP, and this includes the design, implementation, and maintenance of the internal controls relevant to preparing and fairly presenting financial statements that are free of material misstatements, whether from fraud or error. The auditor's responsibility is contained in the next three paragraphs and includes the responsibility of the auditor to express an opinion and explains that audits involve performing procedures to obtain evidence about the amounts and disclosures in the financial statements. The second paragraph also explains internal controls and how the auditor is not expressing an opinion on the internal controls, but does consider them in determining if they are relevant to the presentation and preparation of the financial statements. The last statement concludes that the auditor believes that the audit evidence that was obtained is sufficient and appropriate to provide a basis for the audit opinion. The report concludes with the opinion of the auditors. The opinion shown is an unmodified or unqualified opinion. It includes the financial statements that were included in the audit, as well as the years, and states that they present fairly in all material respect the financial position, results of operations, and cash flows. The opinion paragraph would differ if the auditor reached another conclusion about the financial statements, as we will see later in the chapter. It is important to note that the opinion does not guarantee the correctness of the financial statements because the statements include many estimates and the auditors did not make a complete and detailed examination of every transaction. As we stated earlier, there are other types of opinions that can be issued by the auditors if they do not issue the unmodified opinion we looked at earlier. Sometimes the auditor will wish to emphasize a matter and will include an additional paragraph. The report is still unmodified but has an additional paragraph. The auditor may issue a qualified opinion if there is a scope limitation or departure from GAAP. More severe than a qualified opinion is an adverse opinion, which states that the financial statements are not presented fairly. This opinion is issued when there is a departure from GAAP so significant that the financial statements as a whole are misleading. Last, the auditor may disclaim an opinion if they are unable to determine the overall fairness of the financial statements. This type of opinion is issued when there are very significant scope limitations. This diagram shows some of the additional types of engagements that would be covered by the AICPA attestation standards. These standards are meant to serve as a general framework and set boundaries for the attest functions that are not financial statement audits. The PCAOB adopted the AICPA attestation standards as interim standards for attestation engagements related to the financial reporting of public companies. CPA firms should establish adequate quality control policies and procedures to provide reasonable assurance that professional standards are followed on every engagement. The AICPA has issued statements on quality control standards that identify 6 elements of quality control. These 6 elements include leadership responsibilities for quality within the firms, relevant ethical requirements, acceptance and continuance of clients and engagements, human resources, engagement performance, and monitoring. We will look at each of these elements in detail next. Leadership responsibilities include the firm's internal culture or tone at the top that emphasizes the need for quality, including performing work that complies with professional standards and issuing reports that are appropriate to the circumstances. An example of a design feature would be to assign management responsibilities so that commercial considerations do not override the quality of audit work performed. Firms and personnel need to comply with relevant ethical requirements. An example of a design element would be to obtain annually a written confirmation of compliance from all personnel who are required to be independent. Firms need to have guidelines that will ensure that engagements are undertaken only when the firm is competent to perform them and when they are able to comply with legal and ethical requirements. They must also only accept and continue with clients that have integrity. An example of this would be deciding whether to continue with a client relationship after considering significant issues that have arisen during the current or previous engagements. Human resources includes having sufficient personnel with needed competence, capabilities, and commitment. An example would be to design effective recruitment processes and procedures to help the firm select individuals of integrity who have the capacity to develop the necessary competence and capabilities to perform the audits. Engagement performance includes ensuring that the firm's engagements are consistently performed in accordance with professional standards and regulatory and legal requirements. An example would be to design policies and procedures for tracking the progress of each engagement. Last, the firm should monitor the policies and procedures relating to quality control to make sure they are operating effectively and are relevant and adequate. An example would be that working papers, reports, and client financial statements are reviewed to assess their compliance with the firm's quality control policies and procedures. Quality control standards will be different depending on the size and nature of the CPA firm, but every CPA firm should have some type of quality control procedures in place for every aspect of its practice to provide assurance to the clients and public that the firm can meet its responsibilities to the public and clients. As we have stated previously, the PCAOB is responsible for regulating public accounting firms that audit public companies. As part of their regulation, PCAOB staff performs inspections of the public audit practices of registered public accounting firms for compliance with Sarbanes-Oxley, PCAOB and SEC requirements, as well as professional standards. The AICPA and state boards of accountancy require that CPA firms undergo a peer review performed directly by a CPA, CPA firms, or a team of CPAs. This review can either be a system review, which is a study and appraisal of a CPA firm's system of quality control pertaining to accounting and auditing work, or an engagement review, which includes a review of a sample of the CPA firm's actual accounting work. The PCAOB is composed of 5 members, only 2 of whom are CPAs, selected among prominent individuals who have demonstrated a commitment to the interest of investors and the public and have an understanding of the issues faced by the PCAOB. The members are appointed by the SEC and serve no more than 2 5-year terms. All accounting firms that audit SEC registrants must register with the PCAOB. As part of that registration process, each firm pledges to cooperate with any inquiry made by the PCAOB. The PCAOB may impose monetary damages and may suspend firms and accountants from working on engagements for publicly traded companies and refer cases to the Justice Department for consideration for criminal charges. Members of the AICPA who are in public practice with a firm that performs accounting services that are in the scope of the AICPA's practice monitoring standards must practice with a firm that is enrolled in the AICPA peer review program. A firm must undergo a peer review by another CPA, a CPA firm, or a team of CPAs every 3 years. There are 2 different types of peer reviews: system reviews and engagement reviews. A system review involves peer reviewers' study and appraisal of a CPA firm's system of quality control to perform accounting and auditing work. This type of review is for CPA firms that conduct audits. An engagement review is one in which the peer reviewers select a sample of a CPA firm's actual accounting work, including accounting reports issued and CPA firm documentation, to evaluate whether the reports and procedures are appropriate. This type of review is only available for the firms that do not perform audits. The reviews must indicate either pass with deficiencies, or fail. In addition to peer reviews, CPA firms with SEC registrants as clients are required to have an inspection performed by the PCAOB staff. The frequency is based on the number of public clients of the CPA firm. Those with more clients have an annual review, and those with fewer clients are inspected less often. Inspections by the PCAOB staff differ from peer review conducted by CPA firms. Generally, the PCAOB staff focuses on selected quality control issues only, and also may consider aspects of practice management, but the main focus is on evaluating the performance of a sample of individual audit and review engagements. The inspection results in a written report transmitted to the SEC and appropriate regulatory authorities. While the content of most portions of the report is made available to the public, discussion of potential defects in a firm's quality control are not made public unless the firm does not address the issue within 12 months. International Financial Reporting Standards, or IFRS, are developed by the International Accounting Standards Board, which has as their objective to develop a single set of high-quality, understandable, and enforceable global accounting standards. The SEC accepts IFRS for foreign companies that issue securities in U.S. markets. Audits are conducted for financial statements using IFRS for U.S. purposes, the same as those where GAAP is used. However, these audits will require an understanding of the difference between the two standards. The International Auditing and Assurance Standards Board of the International Federation of Accountants made significant modifications to the International Audit Report, similar to the changes made by the PCAOB. Some differences between it and the PCAOB report include the allowance to change the wording of the report to conform to that required in other countries, and to include that the financial statements comply with the provisions of a country's relevant statutes and laws. It now includes a paragraph similar to the critical audit matters paragraph in the PCAOB report, but it is called key audit matters. The International Audit Report also allows for the inclusion of the name of the auditor on the audit report, or the firm's name, or both. In some countries, auditors have other reporting responsibilities, and if this is the case, they should be included in a separate section of the report after the opinion paragraph. And that is the conclusion for the presentation on Chapter 2.